you, Sydney. Well, hello, everyone. I'm Jonathan Sandlund. I run the crowdcafe.com, where I publish research and my thoughts and data on the investment crowdfunding markets globally, which I've been looking at and studying for the past year and a half. So with that, we'll kick it off, and I'd love you guys to introduce yourself and talk about what you're doing in the space and really who you're working with.
Hi, my name is Alfredo Guilber. I'm with the Digital Film Cloud Network, and we are a movie exchange. Inside our platform, we also have a crowdfunding capability. The reason I'm probably sitting here is because I'm also really into the crowdfunding and the collaborative market. I collaborate with a couple companies in the same market.
Hi, my name is Mark Fidelman. I write about the space. I also have clients that are in the crowdfunding space, actual crowdfunding platforms, very interested in sharing their perspective I've learned from what's going on out there. And generally have a very good understanding of where this is headed according to all the thought leaders in the space that I've been able to interview. So happy to share my perspectives on that.
Hi, I'm Chris Tyrrell. I'm the CEO of Offerboard, which is a Title II platform launching next month. I'm also on the board of the Australian Small Scale Offerings Board, which is the oldest small securities platform in the world. I'm also the chair of CIFRA, which is the crowdfunding industry's regulatory advocacy organization.
Hello, everybody. I'm Jeremiah Owyang. I live right down the street. Coincidentally, I get just about everything in my life from the crowd. In fact, since June, I've only purchased 40 durable goods. I get things on demand or rental, or the shirt is from Trunk Club, so everything is coming from the crowd. From a day perspective, I'm the founder of Crowd Companies. We are a 4-month-old an association for the Fortune 500. So the members include GE, Hyatt, Walmart, Nestle, Whole Foods, all the large corporations. There's 29 in. And I'm showing them how to collaborate with the crowd for new-based business models. One interesting thing is, even though I have CMOs in the council, they're not allowed to use the word consumer because the crowd is starting to build their own products, fund their own products, design their own products. I want corporations to think as the crowd as their partner, not somebody they sell to.
And so you guys are all looking at, quote unquote, the power of the crowd. But if you look at financial services and you look at the crowdfunding sector today, the second you prove a financial asset is two things. One, it's attractive from a risk-reward standpoint. And two, it's scalable. You'll see institutional capital come in. We've seen this in the peer-to-peer marketplaces. You start out with individuals. The second it develops a track record, institution comes in, and it moves with such speed and aggressiveness that for the marketplaces, it's hard to turn away. So do you see these crowdfunding markets, when they hit this track record, do you see the crowd being crowded out? What is the role of the crowd and why?
That's an awesome point of view, because actually we build our platform based on that. Our crowdfunding platform is totally free for that reason. We believe that right now the crowd is a way to validate viable projects, specifically in movies. So we live for that. We live for using crowdfunding to find the specific target audience for a specific movie. We can find out that the movie is being crowdfunded by people between 25 to 35 years old. We are able to find out how big they are, how good are they connecting with their specific crowd, and then we follow up with investment.
I think the crowd will continue to do things that only crowds can do. I think in the peer-to-peer marketplace, underwriting of small debt issues is a process that doesn't necessarily need a crowd. The people who are being served by that marketplace were served by the crowd when the institutional capital wasn't coming in, and the crowd basically helped build the risk-balanced scalable model that caused the institutional capital to come in. 92% of what's on Lending Club now gets funded directly through the API by institutional capital, and the crowd doesn't even get to see it. I think that what's going to happen, though, is there are activities that the crowd can identify opportunity in that can't be identified by institutional capital, or inefficient to be identified by institutional capital. And I think institutional capital will come in for a portion of those after the crowd has identified them, but I don't think it can ever capture them, because I think the crowd can always stay ahead of institutional capital.
Yeah, I would like to add on to that. So let's take a look at the benefits of a crowd versus a institution or corporation. And they both bring something very interesting but unique. So here's what crowds are great at doing. They're great at bringing a lot of creativity, flexibility, and speed. That's what crowds are great at doing. But what companies are good at doing is they have a trust mark. That's a logo. So they offer consistency, and they bring a supply chain and resources. So when you marry the two, and that's really what this conference is going to be looking at and thinking about these trends, is the crowd and companies start working together as one. That's the big trend.
Yeah, so it seems if you can define the value of the crowd, the value, especially you take movies, for instance, where the value of a distributed cap table, the value of a film producer of having 10,000, potentially 50,000 shareholders, it's obvious. You're predicting demand. Not only that, you're actuating the demand when the movie comes out. If you can define that, that's where the power of the crowd comes in. Whereas in marketplaces, Chris, to your point, that are more automated or as debt, it's really tough to look at how the crowd will participate in that if it can be automated and sort of pass through. Because then you look at where is the source of capital coming from, and institution can sort of just come in and take it over. On that note, looking at consumer peer-to-peer markets, let's take car sharing. How does that differ with financial peer-to-peer markets, and mainly the fear that consumers have with financial products in general and financial services in general? How do we overcome that gap?
Jump on that. So is the question around, car sharing we seem to be comfortable with that, but not in sharing our financial information or lending money to one another?
Or making a financial decision. So, for example, I use Get Around, and actually when I came here, I used Air Ride, which I get to the airport, somebody picks me up, takes me to a lot a mile away, and I drive away in somebody else's car. It's amazing. It's frictionless. And as a consumer, I don't think twice about doing that. But many people, the second you ask them to make a financial decision, they don't want to touch it. They have financial advisors for a reason. So when we move into financial peer-to-peer marketplaces where it's like, okay, now I can invest in my friend's restaurant or I can invest in another business, do I want to make that financial decision? And if not, how do we overcome that fear and that educational gap of empowering people to make their own financial decisions and not just sort of offload them in peer-to-peer marketplaces?
Yeah, well, what I tend to do is I listen to the crowd. I look at what the crowd is saying about this particular investment. And restaurants, by the way, are terrible investments typically. So I don't need a crowd to tell me. Yeah, good point. But I just think finance is riskier than getting in a car and driving a few miles. If you're making a significant investment, especially in another company, I want to know a lot about that company. But if I don't have that expertise, and I'm either forced to invest in the company or I see it's an emerging technology, I will ask as many people as I know. So if there was a way that a platform can kind of aggregate that knowledge and give me straight facts, here are the risks, here are the opportunities, and here are the potential competitors or market challenges, I think education from the crowd would help people feel more comfortable in investing in that type of marketplace.
Yeah, I'll jump onto that. So you guys heard of eToro out of Tel Aviv? So they haven't really moved into the American market because of regulatory concerns. So eToro is a trading platform that's peer-to-peer. And the way it works is regular people will be like day traders, or amateurs, just this is a side job. They start trading. And they start looking at those that are successful. And the crowd can see who are the successful people who are trading stocks. And what starts to happen is a tripling effect by the crowd starts to double down and bet right onto their bets. So these amateur brokers or traders that are not working on Wall Street, they're just regular people, are starting to make the call for the rest of the crowd, and the crowd is betting on the winners in the crowd. So that's one thing that's already starting to happen, eToro.
So Alfredo and Chris, you guys are both looking at running marketplaces. Today, that's accredited investors only. Are you working with accredited investors? And if so, how are you looking at that? And Chris, can you talk about your plans for how do you onboard a new generation of accredited investors who have never before invested in private companies?
Well, before I also would love to add the answer from Mark, I think the first step, and this is also related to your current question, I think it's going to be a two-step fall. The first step is people is going to start trusting in what in the market are called suits. That's what the angel list is doing. It's like, okay, I already know Mark has a lot of knowledge in this specific market. Every time that Mark makes a bet, I'm going to make a bet behind Mark. Instead of the crowd, I'm just following a specific person that I believe has the knowledge in that specific area. And now back to your question, we have it really easy because everybody knows that the movie industry is probably worse than investing in restaurants, but you can make a lot of money on the movie industry. So the few people that is calling the shots on the movie industry is in our platform also for another reason. The crowd investing is already happening between angel investors. If I have a friend, and for example, I actually have a friend who is excellent investing in ecotouristic properties. Every time he calls me, Alfredo, I just invested in something, I usually play behind him because I know he has the knowledge. That is the power of the crowd in the angel investor. You usually follow who is already investing there. Because there's another reasons. When you are investing in somebody who knows the market, that person also helps that investment to be successful. That's where we are playing. When a distributor put money on a movie, we know that that distributor is going to help to drive the distribution of that specific movie. So for us, it's easier because all our investors are usually accredited investors and are institutional investors.
Bringing on a new class, a very large new investor class of angel or venture investors through crowdfunding is a daunting task. I mean, you're talking about going from 60,000 by some people's estimates active angel investors to 600,000 or even larger.
Of the 8.6 million.
Of the 8.6
9
million,
million, whichever
right?
number.
So you're talking about you're talking about a significant change and a significant number of people that need to be educated about the risks attendant with investing in startup ventures, early stage ventures, even growth investors. And I think you also need to give them tools to understand those. Some of those tools are just the ability to follow what other investors are doing. Some of those are building panels of experts that actually make decisions about the space. One of the things we're building right now is a network of people who have regularly done particular kinds of deals to provide additional information about those deals. We're also trying to organize data around giving the crowd more information about a listing that may be provided directly by the issuer, data around that market in that particular geography at that particular time, which is a lot of investors, professional investors now don't have that kind of data, but the development of a much larger marketplace is incentivizing people to use data to help inform the novice investor or the new investor as they make these decisions. A third thing that I think is going to happen are informal networks of people are going to start communicating. One of the tenets of Title III of the Jobs Act is that all of the communication has to be aggregated through a single platform. And I think that that's going to change the way in which that information is delivered and the value of the information that comes from every potential investor dialoguing with a company effectively in public, at least as to the registered users of a site that are watching that particular listing.
I would just say that most of us can't do day trading correctly. So if we can't trade stocks, how are we going to get to a point where we bring on people that are investing in companies? And so I think it's actually a couple of evolutions that need to take place. One is, if you're going to be an angel investor, you dang well better know the product and the team behind it, and you better be prepared to help them. I think the answer is, if you can help a company become successful through your contacts or through your experience or even getting involved somehow, I think that's the way we bring new people into this type of thing. I would be fearful if you didn't know what the company did, unless it was a low investment that you're making under a couple $100. I'd be fearful to ask you to get involved in a project of mine, for example. I'd want you to know what you're getting involved in before you actually invest money, because if you look at the statistics, very few of these things become successful, right?
And so there's an adage in angel investing that angels will only invest in you for one of two reasons. And if you're pitching for angel capital, if you don't fit in one of these two reasons, you're wasting your time. One, they know the industry, or two, they know you. That's it. Now, if you look at most individuals, how many industries do they know? probably only one, the one that they work in. And how many individuals do they know that are raising capital? Not that many. So by that rule of thumb, you may say, okay, most individuals may not look to directly invest because really you have to have that very strong social motivation of either I know the industry or I know you. So moving assets into the private markets in a meaningful way at scale, and you're seeing this, is probably going to require a fund structure or some sort of access point that is low cost and diversifiable. And we've seen platforms early on the accredited side, they've shifted from direct investment to funds. And they're moving more towards funds. Funders Club, for instance, started out direct investment only. They gave you the issuer, you could invest. Now they've shifted towards managed funds where you can invest X dollars in a fund that invests in Bitcoin and payments or hardware. In recognition that many of their investors said, hey, you know, I love direct investing, but I don't have a ton of time. I don't really know this industry. And really, I just want access to the private markets. That in mind, how do we bring investors into the market with a fund structure? And especially when many of them are making financial decisions through intermediaries, whether that be their financial advisor, their accountant, or another trusted individual. How do we crack that incentive structure of the financial advisors and others intermediaries to bring them into these markets? And Chris, I guess it's probably most directly aimed at you guys. If you're looking at, can you go to these intermediaries and offer sort of a lower cost, more diversifiable, hands-off way into the private capital markets?
I think we're going to see, in part, a rise of 40 Act funds, actually publicly traded funds that are trying to structure investments in the private markets, because I think most of the available private market fund structures that aren't Funders Club compliant, that aren't just venture funds, are going to be difficult to manage at scale because of the various limitations placed on them regulatorily. I think there are going to be platforms that do platform-based fund. We Funders doing a staff picks fund right now, where they just do, you invest in the staff picks and their staff, you know, picks some of the Y Combinator alums or whoever's on their platform. I do think that individual investments can scale if the usability is improved around getting to the investments that someone wants. We're looking at a couple of things. So first, I want to question the premise of your question. I think people know a lot more other investors or other companies to invest in than they know. I think they're in tertiary networks mostly, and we're working on some technology to try to help people find the other investment-related people in their tertiary networks, because it's a much larger set of data for most people. I mean, I have, if you look at LinkedIn, because that's an easy way to figure out how big your tertiary network is, I mean, I have 1,400 people at my primary network, and that turns into 14 million people in my tertiary network. And so the ways in which we know someone have changed. Not all the people, I'm sorry to any of you in this room who are Facebook friends of me, not all people who I say I'm their friend on Facebook, I would actually define the old way I used to use the word friend. In the same way, someone I know in the marketplace is changing as well, because of the ways in which we're connected more deeply through social than we ever have been before. And I think the same is going to be true of investments. We're talking with a potential partner right now who said, we can help you design a platform that will only show people deals where there's someone in there within 3 degrees of separation. And so we're thinking about even building that into the technology. So I think it's going to be just as different as a garage sale is to eBay, is the new way of investing to the old way of investing. eBay and garage sales are exactly the same thing. It's a used item between two strangers exchanged for money. But the experience of them is so different that you can't even really compare them. And I think in the same way, the new way in which investment activity occurs is going to look that different 5 years down the road as eBay looks to a garage sale, comparing it to the way in which people invest today and people think about making investments today.
Yeah, so you're local, from proximity to global. I just did a research report published on March 3rd. I want to share the stats. It's pretty telling. So I worked with Vision Critical. They can survey thousands of people. So we surveyed 90,000 people across the United States, Canada, and the UK. And we asked them questions related to the sharing economy, the maker movement. But here's the stats related to peer-to-peer lending and crowdfunding. So we asked this general population of 18-year-olds and older, and I'm going to tweet out the link in just a sec. How many of you have done peer-to-peer lending or crowdfunding in the last 12 months, at least one instance? And the adoption rates are 5% for peer-to-peer lending, like Lending Club, and 6% for crowdfunding. So that is the current general population behavior, at least once. When I speak to crowds, I say, how many of you have funded something in Kickstarter? Lots of hands go up. So it's a pretty low barrier of entry, but it's an indicator. So here's the kicker. We also asked them, what are you going to do in the next 12 months? And so here's what they said. 10% for peer-to-peer lending and 12% for crowdfunding. It's going to double in just 12 months. That is what they said explicitly. It's going to double. So if you take, I'm going back to your question, is how do you get traditional institutions to take a look at the space? The crowd is going to rise in this. It's a doubling in behavior. They have no choice but to look at it as an opportunity.
Yeah.
Yep.
And Chris, to your point on how big is the addressable market, how many people do we know that are raising capital? You look at just also place, your city. You know, you look around, how many restaurants are there that we may not know them directly, but we know them through friends of friends. And now, you know, for the first time, we actually know that they're raising capital because they can advertise. Jeremiah, you know, your research on the peer-to-peer space, we've seen time and time again a winner-takes-all outcome. So there's one Airbnb. You look at Uber versus Lyft. There's probably going to be one. Do you see winner-takes-all in financial peer-to-peer as well?
Well, it's not. There's no clear winner yet in any of those categories. Airbnb, yeah, it looks like they have the lead. But for the car sharing space, there's 5 business models. There's co-ownership. There's borrowing somebody's car. There's rental. There's peer-to-peer. There's actually quite a few players. And then in every country, we see different ones. So in UK, it's BlaBlaCar, right? So the jury's still out if there's going to be a dominant player. And then you look at so that's transportation. And then the good space, there's startups. There's 5 categories of crowd business models. Okay, there's goods, which is you talked about eBay. There's services like TaskRabbit, Nodesk. There's shared space like Airbnb, and then co-working like Liquid Space. Then there's transportation. I just ran down a whole bunch. And then there's the money sharing. So there's 5 categories, and there's not real clear winners yet across all these except for space. So it's early. But in general, and I was an industry analyst at Forrester, so I look at markets. And in just about every category, I tend to see tends to be 3 dominant companies in any category. The biggest, the better, and different. We have like Facebook, Twitter, and then LinkedIn is different. Or BMW is better, you know, Ford is everywhere, and then Mini is think different, you know. So 3, I tend to see patterns of 3 in every category.
Mark, looking at the space and writing about the space and researching the space, what is top of mind for you right now?
Well, top of mind for me would be, hey, if my industry or my company can be disintermediated, or it can be replaced by some kind of what Jeremiah talks about a lot, by a crowd-enhanced business model, then I better be looking to the future to either adopt that business model myself or to make a quick change. I mean, do you see what's going on with Uber and taxis right now? I mean, they have to outlaw Uber to stop the progression, right? And that's only because we've got some government bodies that are still in the pockets of some of these taxi organizations. It's really unfortunate. But if your business can be destroyed, or it can be, I'm trying to find a more polite term to say this, but disrupted.
Obsoleted?
Disrupt is a good word. Obsoleted.
Punked. I like punked.
And
By this new trend, you're in real trouble.
so who are those businesses? Who are the ones that are most likely to be obsoleted or disrupted in the next 12 months? Or is it 24 months?
It could virtually be any area. I can't think of a single one that, unless it's heavily, heavily regulated, or there's somehow a government monopoly behind it, I'd say that
Probably capital markets?
capital markets easily can be disrupted. Yep.
Yeah, back to that. We run an analysis about what industries are easily disrupted, and you see it easily. The 2 biggest ones that got ahead: the transportation one, and the real estate one, as a property, call it office or call it rental property. Everything that you call a mature market is ready for disruption with economy. Everything. Just download any analysis about mature market. We find that I'm actually involved in one. called Tool Locker. Everything that is home repair, everything that is considered a mature market, because the only limitation to go into a mature market is capital, because you need to buy something. You need to buy, if you're a taxi driver, you need to buy 100 taxis, or you need to buy an entire building to have an hotel. So all those things are being leveraged just using the property of a lot of people and making it available for the rest of the people.
So I think we have a few more minutes. We'll open it up to questions if anyone has any. Yes.
Yeah, what I'm curious about is we've used prediction markets in a lot of other fields like box office receipts or elections and stuff like this, weather prediction. And it seems to me that the Google of crowdfunding tomorrow is piecing together data feeds from all these crowdfunding platforms and creating prediction markets on them. And angels confuse, VCs, whatever, but your people as well. And so I'm kind of curious of your thoughts about using prediction markets or where that's going.
Love it. It's just really, really, really difficult to do. And it can be gamed, unfortunately. Some of the ones that have been successful, like InTrade, I think out of the UK, were banned here, which I find unfortunate because when you're voting with money, you need to have a lot more serious people that are involved there. But I totally think that's the future. Yeah.
I agree. We collect the data from Seed and Spark, from Kickstarter, from Indiegogo, and we use that data to understand the cloud that a movie potential is going to have.
But they're not sharing all the data with you, I would bet, right? Not
No, the
everything.
filmmaker is the one who actually, we asked the filmmaker, give us the data from your crowdfunding campaign, and they are happy to do it. And that way is when we make the recommendation, your marketing should be targeted to male 16 to 25. And probably his previous campaign, he was thinking that his target market was 45 years old.
This sounds like a great model for freemium, right? You got the premium data where people want to pay for it, and the freemium stuff, maybe they don't get the better data.
Yeah, in our case, everything is free because we make the money because we want that the movie succeeds. So because we make the money is when you sell your movie to a distributor or a TV network, and we use that data to sell the movie to the network. We say to the network, hey, your target is 16 years old. Probably this movie doesn't look like your target, but look, all these people is behind this specific movie.
And if you look at how that's going to affect the capital formation process, take a look at traditional investment banking, boutique investment banking, which is probably going to be one of the first to be heavily disrupted in the next 5 years. Whereas today, an issuer goes to them and says, I need to raise $15 million. And they're going to put together PPM, they're going to do a roadshow, they're going to go all around the country. And they're going to all these cities, and they have no clue if demand is there. No clue. They're wasting all this money, all this time. It's insanely inefficient. Whereas now a platform like Offerboard, or even if you're doing film finance as well, can say, hey, we're getting early interest, investor interest from 5, 6, 7 geographies. Let's go there. And so we'll see that predictive, and what we'll see, especially as this market moves up, we're going to see blended online to offline. And that'll be critical in having insight into where investor demand is and be able to blend those two to do large transactions, meaningfully sized transactions that aren't, just early stage. So with that, I think it is time for lunch, and thank you all.